The best stocks to buy now. Simply put, 2022 was a year marked by growing prices, skyrocketing interest rates, and worries about a recession. Growth and tech companies were crushed. The S&P 500 lost 18.3% through December 15th, and the energy sector emerged as the big winner as commodities surged and the sudden outbreak of the Russia-Ukraine war disrupted international energy markets. However, opportunities are still there going into 2023 due to the quick rotation out of names that are more growth-oriented. Investors now have the opportunity to purchase shares in well-established companies at a discount simply because of some short-term fears thanks to the sale of a number of high-quality names. Even though it goes against the emotional nature of most investors, buying equities during a slump has traditionally been a wise move. Now, in this video, we will be talking about the top 5 best stocks to purchase in 2023. But before I continue, I would like to welcome my new viewers and urge you to subscribe to this channel. Also, don't forget to like this video. Number 1. Meta Platforms Incorporated. The year 2022 was terrible for Meta Platforms. In general, social networking stocks had a bad year, and Meta stocks had a particularly bad year. Mark Zuckerberg, the founder, has made significant investments in the metaverse despite what appear to be bleak prospects for the near future. In the meanwhile, there are numerous obstacles facing the advertising industry. In comparison to more recent competitors like TikTok, Meta's main platforms like Facebook and Instagram have lost part of their appeal. However, in terms of Meta's future, 2023 may mark a turning point. Given the chaos at competitor Twitter, Meta's issues are no longer in the news. A potential TikTok shutdown or regulatory crackdown might significantly help Meta. Additionally, it appears that some of the more costly costs associated with virtual reality and the metaverse will be reduced by Meta's management. Meta shares are well positioned for a substantial rebound in 2023 with any improvement in sentiment, given that they are trading for less than 15 times forward profits. Number 2. Etsy. Before the COVID-19 outbreak, Etsy was expanding wonderfully by matching creative entrepreneurs with clients seeking items that were a little bit more unique than the typical fare from online retailers. The pandemic saw a dramatic increase in e-commerce, but Etsy certainly took off, expanding at a rate that is more than twice as fast as general e-commerce. The fact that Etsy was a logical fit for customers looking for distinctive face masks undoubtedly helped, but the site's expansion has been amazing in all product categories. In comparison to comparable pre-pandemic levels, Etsy's marketplace sales volume increased by 141% in the second quarter of 2022. You'll see that I pay attention to strong platforms throughout this list. Without a doubt, Etsy is one of them. Few online retailers can compete with Amazon and remain successful. When Amazon launched its own platform for handmade goods, Etsy not only made it through, it triumphed. However, this could only be the beginning of a fantastic long-term growth narrative. Etsy's market opportunity is in the hundreds of billions of dollars, and it has only begun to scratch the surface because of its platform and brand strength. The recent growth stock slump caused the stock to drop considerably, so it might be an excellent moment for patient long-term investors to take a closer look. Number 3. Apple Incorporated. Unless you count state-owned monopolies like Saudi Aramco, Apple is the largest publicly traded firm in the world. Shares of Apple, like many other tech equities, struggled in 2022 as investors were scared off by predictions of a recession and rising interest rates. An unusual 23% drop has left Apple trading at 22 times profits, providing a reasonable entry opportunity for the $2 trillion iPhone maker. Apple's sales and stocks are more stable because of the company's ecosystem, which encourages customers to keep with Apple goods and increases the likelihood that they will upgrade to a more advanced model each year. Apple spent approximately $90 billion on stock buybacks in the last fiscal year, so even though its 0.7% dividend isn't anything to write home about, the business is committed to repaying its large cash flows to shareholders through the dividend and share buybacks. Number 4. Pinterest. Pinterest is a place where people may concentrate on objects rather than people. Pinterest is a visual bookmarking and sharing service that helps users become motivated to complete various projects, such as constructing a dream deck, making a kid's birthday cake, or changing their clothing. Because its user base dropped slightly when pandemic limitations were eased around the world, Pinterest was hit hard by the 2022 market downturn. Nonetheless, recent financial figures suggest that the number of users has leveled out for the time being. Furthermore, Pinterest has a very small user base compared to Facebook, so there is a great deal of room for future expansion. Pinterest's massive opportunity to monetize its users is the most intriguing factor for long-term investors, especially as the business moves away from its traditional ad-focused strategy and tries to discover ways to incorporate e-commerce into its platform. Pinterest just appointed e-commerce veteran Bill Reddy as its new CEO to speed up its transformation from a social media platform to a site where people go to find goods they might want to buy. Investors that are willing to wait for the company to reach its full e-commerce potential may be rewarded handsomely. Advertising, lead creation, and product placement could all flow much more naturally if consumers were already present and actively engaged with the platform. Internationally, where 80% of its user base resides but only accounts for a tiny fraction of its revenue, the monetization potential is huge. Number 5. Realty income. Realty income, or REIT as it is more often known, is a company that invests in commercial real estate on behalf of its shareholders. Top tenants include well-known names like Walgreens, NASDAQ WBA, Dollar General, New York Stock Exchange DG, and FedEx, New York Stock Exchange FDX. Realty Income has a portfolio of over 11,000 properties in the United States and Europe, the majority of which are less susceptible to the effects of the recession and online shopping. The triple net lease structure used by Realty Income further contributes to the company's consistent and reliable cash flow. The results speak for themselves. Since its New York Stock Exchange debut in 1994, Realty Income has generated annualized total returns of 15.1%, easily surpassing the S&P 500. It has increased its dividend payment an astounding 116 times with no dividend cutbacks and almost 600 straight monthly payments, current annual yield is roughly 5%, to shareholders. That's all for this video. Thanks for watching, and make sure you like and share this video, and be sure to subscribe to the channel for more updates.